Trading is an unpredictable game. Every day you're confronted with fluctuating charts, changing trends, and a market that never stands still. For many traders, the most stressful and daunting aspect of this journey is navigating market reversals. Those sudden shifts in price that can shake your confidence, test your strategy, and, if you're not careful, leave you reeling emotionally. We've all been there. The market moves against you, your position starts to turn red, and the pressure mounts. You might feel a rush of panic, thinking the worst is happening and you've made a huge mistake. In these moments, it's easy to lose control. Your heart races, your thoughts blur, and decisions become increasingly reactive. But this isn't the moment to panic. This is the moment to pause, to breathe, and to trust that you have the tools, strategies, and mental strength to handle the situation calmly. How you respond to market reversals, how you manage that surge of emotion, how you make decisions under pressure will ultimately determine your long-term success as a trader. In fact, it's not the losses themselves that derail traders, but the inability to handle emotions during those inevitable setbacks. Panic can lead to rash decisions, cutting losses too early, abandoning your strategy, or worse, revenge trading, which only leads to greater losses. But there's a better way. Instead of reacting to market reversals with fear, frustration, or anxiety, you can use these moments as opportunities to prove your emotional strength. Trading isn't just about executing technical strategies or analyzing charts. It's about mastering yourself. It's about learning to detach from the outcome and approaching each trade with the mindset of a professional, calm and rational in the face of market uncertainty. In this guide, we'll explore how you can handle market reversals without panicking. We'll uncover how to shift from fear-driven emotional trading to a calm, strategic approach, one where risk management, patience, and emotional control take center stage. You'll discover practical techniques to help you weather the storm when things go south, regain your composure, and come out the other side as a more confident, disciplined trader. One of the hardest aspects of trading is embracing the reality that losses are inevitable. No trader wins every trade. But what separates successful traders from those who struggle is how they handle those inevitable losses. Instead of seeing a market reversal as a defeat, you can view it as a part of the process, a signal to review your strategy, reflect on your decisions, and refine your approach. This mindset shift is where true growth happens. The ultimate goal isn't to avoid market reversals or losses entirely. That would be unrealistic. The goal is to train your mind and emotions to handle them with grace and composure. When you can remain calm, trust your plan, and make decisions from a place of clarity, you will find that you not only survive the market's twists and turns, you thrive in them. So let's begin this journey to mastering your trading psychology. Through a series of practical strategies, insights, and techniques, you'll build the mental resilience needed to handle market reversals with ease. It's time to take control of your emotions, trust in your process, and navigate the unpredictable world of trading with confidence. Chapter 1. The Calm Before the Storm. Preparing your mindset. You've seen it happen before, haven't you? The market moves in one direction, then, without warning, it suddenly changes. The reversal comes out of nowhere, and in the blink of an eye, everything you thought was certain feels upended. You can feel your pulse quicken, your stomach tightens. There's a familiar ache, a sinking feeling that spreads through you, almost like dread. But here's the thing. You can do something about it. You can prepare yourself for those reversals, and when they happen, you won't panic. Market reversals are inevitable. They are as much a part of trading as the steady rises and falls of price charts. The question is, how do you deal with them? How do you keep your cool when everything within you is screaming to exit, to run, to take action? It's all about your mindset, the mental preparation that you lay out in advance before the storm hits. The goal here is simple: to stay calm, to stay strategic, and to stay in control. Understand the nature of the beast. At its core, the market is a living, breathing entity, a mass of human emotions, decisions, and reactions. Every price movement reflects fear, greed, excitement, or uncertainty. And at some point, no matter how meticulously you've planned, a reversal will strike. It's part of the process. Instead of focusing on how unexpected the move is, focus on how expected the possibility of a reversal is. This shift in perspective alone can help you feel more prepared when it happens. Think about it. When you recognize that reversals are not random, but natural occurrences in market cycles, you begin to lose that sense of panic. You stop seeing them as disruptions or mistakes and start seeing them as opportunities for growth. They're just another element in the rhythm of the market, a rhythm you can learn to move with. Prepare your mental framework. When that market shift comes, the first thing you need to do is pause. Let the initial emotional reaction settle. Too many traders make the mistake of reacting instinctively when they see the reversal, feeling the need to make immediate decisions. But this is where the emotional fog sets in. You're trying to make decisions while your mind is clouded with panic or fear. The goal is to give yourself the space to breathe. Here's how you can mentally prepare. Acknowledge the emotion, but don't let it rule you. Emotions are natural. They signal to you that something is happening. Acknowledge that tight feeling in your chest or that rapid heartbeat. You're human. But don't let these feelings dictate your next move. Acknowledge them and then move on. You are not your emotions. You are the one who decides how to respond to them. Slow down your thinking. When the reversal happens, your first instinct might be to do something, anything. But don't rush. Take a moment. Step back. Ask yourself, what is actually happening in the market right now? What's the larger context? If you're too quick to act, you might miss important information or misread the situation. Often, a knee-jerk reaction leads to regret. Slow down. Observe. Assess. Then act. Trust your plan, not your panic. If you've built a solid trading plan, one that accounts for these types of moves, stick to it. The plan is your anchor. When everything around you feels uncertain, you have something stable to hold on to. Review your risk tolerance, your exit strategies, your contingency plans. Trust the plan you've built. Your plan was designed for moments like this. Stay objective, not personal. Reversals can feel like a personal attack sometimes. They can shake your confidence, especially if you've just entered a trade and you're already underwater. But remember, this is the market's natural ebb and flow. It's not out to get you. You're not being singled out. The market doesn't care about your feelings. It's not personal. So when you feel those emotional tides rise, remind yourself that this is just part of the cycle. Your response is what matters most, not the move itself. Use visualization to reframe your experience. One of the most powerful tools you can use when preparing for a market reversal is visualization. It sounds simple, but it's effective. Imagine yourself in a reversal situation before it even happens. Picture yourself experiencing that moment of panic, but instead of reacting with fear or frustration, you breathe through it, assess the situation, and stick to your trading rules. When you practice this mental exercise, it primes your brain for calmness when the real thing happens. You'll be far more likely to respond with clarity rather than emotion. The more you practice this, the more automatic it becomes. The next time a reversal strikes, you won't be scrambling. Instead, you'll be the calm in the eye of the storm, observing, assessing, and acting with confidence. It all comes down to how you frame the situation. Instead of fearing the reversal, you start to see it as just another challenge you're equipped to handle. Chapter 2. Mastering Risk Management. the foundation of emotional control. You've done the mental prep, you steeled yourself for the unexpected, but now comes the critical moment, the reversal. You've already acknowledged the emotional rush, but how do you actually handle the situation when the pressure rises, your position is swinging, and everything feels volatile? The key, once again, lies in risk management. In trading, no matter how much you prepare mentally, if you haven't implemented solid risk management, you're still exposed to that same overwhelming sense of panic when a market reversal hits. A proper risk management strategy is not just about protecting your capital, it's about giving you the freedom to handle uncertainty with composure. It's your shield and your compass when the market feels like it's spiraling out of control. Understanding the importance of position sizing. One of the most crucial elements of risk management is position sizing. It's easy to get caught up in the excitement of a trade, but the real question you need to ask yourself is, how much am I willing to lose? It might seem simple, but it's easy to overlook. In the heat of the moment, you might be tempted to add to a position that's already gone against you, hoping to make up for the loss or to average down. But this can lead to even greater exposure and potential loss if the reversal continues. Instead, practice position sizing based on your risk tolerance. If you know you can afford to lose a certain amount in a worst-case scenario, adjust your position size so that your total loss remains within those limits. This allows you to weather the storm without feeling like the outcome of a single trade can destroy your confidence or your account. A great rule of thumb is the 1 to 2% rule. Never risk more than 1 to 2% of your total capital on any one trade. This keeps you in the game, no matter what happens. When you know that your losses are capped, the emotional tension eases. You'll be able to breathe, think clearly, and make decisions with a head level rather than reacting with panic. Set stop losses and stick to them. One of the most powerful tools in your risk management toolbox is the stop loss order. This small piece of trading technology has the ability to save your trading account and keep you emotionally intact. But here's the catch. It only works if you use it correctly. When you set a stop loss, you're essentially telling the market, I'll exit this position if it moves against me by X amount. That's it. You're protecting yourself from catastrophic losses. The problem, however, is that many traders, especially when under pressure during a market reversal, are quick to abandon their stop-loss order. Maybe they think the market will turn around, or they're convinced that the price movement is just a temporary blip. But abandoning your stop-loss is a slippery slope. It's often the point where fear and denial take over, and emotional decision-making starts to cloud your judgment. The key is to stick to your stop-loss. Once it's set, don't touch it. Trust that you've made the decision when the position was opened, and the market will take care of the rest. Reversals can be sharp, sudden, and unpredictable, but the stop-loss ensures you don't get caught in a situation where the reversal eats up your entire account. The importance of a risk-to-reward ratio. Now that you have your position sizing and stop-loss strategies in place, it's time to look at the big picture, your risk-to-reward ratio. This is a simple concept, but it's often misunderstood. The ratio is exactly what it sounds like. It's the amount of risk you're willing to take relative to the amount of reward you're hoping to gain. For example, if you're willing to risk $100 on a trade, but you're aiming to make $300, then your risk-to-reward ratio is 1 to 3. When the market starts to reverse against you, it's easy to feel like you've lost control. But if your risk-to-reward ratio was set correctly at the outset, you'll find that you can afford some losses without affecting the overall profitability of your trading strategy. This is because you've built in more reward potential than risk. A common mistake is to focus on winning trades and dismiss the importance of managing your losses. But trading is a marathon, not a sprint. To survive in the long run, you need to maintain a favorable risk-to-reward balance. Even if you lose more trades than you win, as long as your winners significantly outweigh your losers in terms of size, you'll remain profitable. The psychological power of risk management. Risk management isn't just a technical strategy, it's a psychological tool. Knowing that you have a plan in place allows you to trade with confidence. When the market is volatile and a reversal occurs, you're no longer in a state of reactive panic. You've already built your safety net, and that allows you to keep your focus. The confidence that comes from knowing your risk is capped means you can make decisions without second-guessing yourself. When you have clear parameters for what constitutes a loss, you no longer feel like the market is actively trying to defeat you. Instead, you see each trade for what it truly is, a potential outcome based on probability and preparation, not fear. In the heat of a reversal, when emotions are at their peak, this confidence is what allows you to stay calm and execute with clarity. If you can learn to trust your risk management strategies and practice them consistently, you'll start seeing the market as a puzzle, one you can solve with the right tools in place, rather than as a battleground where you're constantly fighting to survive. Chapter 3. Strategic Patience. The Art of Waiting for Confirmation. It's a crucial skill that too many traders overlook: strategic patience. In the face of a market reversal, the urge to act immediately can feel almost irresistible. But here's the truth. Often, the best thing you can do is nothing at all. Sounds counterintuitive, doesn't it? But learning how to wait, and wait with purpose, is what separates successful traders from those who buckle under pressure. When the market begins to reverse, your initial instinct might be to take action. Exit the position, hedge, or try to chase the reversal by jumping into the other side of the market. But this impulse is often driven by fear and uncertainty, not rational analysis. It's easy to think that you must do something when the market moves against you, but you need to resist that urge. Why patience is key during a reversal? The market is unpredictable, and reversals don't always develop as quickly or dramatically as they first seem. It's easy to misinterpret the initial signs of a shift as a full-blown reversal, when in reality it may just be a temporary pullback. If you act too early, you might end up on the wrong side of the move, chasing the market in the opposite direction only to find yourself caught in yet another reversal. This is where strategic patience comes in. Instead of panicking, take a step back and allow the market to prove itself. Don't make a decision based on an emotional reaction to a price move. Wait for confirmation. Let the market show you if the reversal is real or if it's just a momentary hiccup in the trend. Waiting for the new normal to emerge. Patience isn't about sitting still in fear. It's about allowing time for clarity. During a reversal, things can feel chaotic and unclear, but with time, the market will settle into its new normal. This is the point where you can start making informed decisions. Consider using technical indicators or price action patterns as your guiding lights. For example, a reversal is more likely to have staying power if it's accompanied by a break of key support or resistance levels, or if volume spikes and confirms the move. Instead of getting swept up in the initial volatility, wait for these key signals. When you see price action that suggests the market is truly changing direction, rather than a simple pullback, you can make your move with more confidence. Take a moment to assess: is this reversal confirmed by multiple factors, or is it just noise? If it's noise, there's no reason to act hastily. But if it's a real shift, you'll have the clarity to enter or exit your position strategically, without the rush. The trap of overreacting. Why quick moves often lead to regret. Many traders, when they see the market shifting, think that if they don't act immediately, they'll miss their opportunity. They feel this urgency, the fear that the market will leave them behind. But often, acting too quickly out of fear leads to mistakes. This is especially true when a reversal is still forming. The market isn't going to disappear just because you didn't act within the first few minutes of the move. Instead of rushing, trust that the market will offer you clearer signals as time goes on. You don't need to act right away. A great example of this is during a false reversal. Sometimes the market will look like it's about to make a big move in one direction, only to reverse again just as quickly. If you jump in too soon, you could find yourself on the wrong side of the move, losing money in the process. But if you wait for confirmation, whether it's a trend line break, a key resistance level being tested, or a reversal candlestick pattern forming, you can confidently enter the trade with a higher probability of success. Patience isn't passivity, it's active decision-making. Waiting doesn't mean doing nothing, far from it. Strategic patience is an active, thoughtful process. It's about consciously choosing not to act until you have sufficient evidence that supports your decision. You're still engaged, still analyzing, still checking in with your plan, but you're not reacting impulsively. Patience in trading requires discipline. It means resisting the temptation to chase quick profits or jump out of a trade because the market feels uncomfortable. It means sticking to your trading rules even when emotions are high, and trusting that the market will give you the information you need to make a smart decision at the right time. When you're patient, you're positioning yourself to make the best possible move, rather than rushing into a decision that might feel right in the heat of the moment, but ultimately leads to regret. This is where many traders falter. They act on emotion, chasing the highs and lows of the market without stepping back to assess the larger picture. How to develop patience. Patience isn't something that happens overnight. It takes practice, self-awareness, and emotional control. Here are some ways to develop patience and get more comfortable with waiting during a market reversal. Accept the uncertainty. The market is unpredictable. The more you accept that uncertainty as part of the process, the less pressure you'll feel to act immediately. There's no way to predict exactly when or where a reversal will occur. But when you stop trying to control everything, you free yourself to act with more clarity and calm. Use the pause button. When the market moves against you, take a deliberate pause. Count to 10. Step away from your screen for a few minutes if you need to. This small action can help break the cycle of anxiety and prevent you from making a rash decision in the heat of the moment. Shift your focus from instant results to long-term goals. Remind yourself that trading is a marathon, not a sprint. It's easy to get caught up in the excitement of a single trade, but real success comes from consistent, long-term results. By focusing on your overall trading plan, you give yourself the space to stay patient during individual reversals and make decisions based on your larger goals. Practice mindfulness techniques. Meditation, deep breathing, and mindfulness exercises can all help train your mind to stay calm under pressure. The more you practice these techniques, the easier it becomes to separate emotion from decision-making in the heat of a reversal.
Chapter 4. Emotional Detachment, the Key to Objectivity. One of the hardest lessons a trader can learn is emotional detachment. It's natural to form an emotional connection with your trades, especially when you spend time researching, analyzing, and executing them. But when a reversal hits and the market moves against you, that emotional attachment can cloud your judgment. You might feel like you've been wronged, that the market is out to get you, and that's exactly when you're most vulnerable to making rash decisions. Emotional detachment doesn't mean you don't care about your trades. It simply means you no longer allow your personal feelings to dictate your actions. It's about stepping back, gaining perspective, and understanding that the market is not personal. No one is singling you out.
The market doesn't know you, doesn't care about you, and certainly doesn't owe you anything. Why emotional detachment matters. When you attach your emotions to a trade, you allow your feelings to influence your decisions. If the market moves against you, your first instinct might be to feel offended. You might think, why is this happening to me? Or, I knew this trade was going to work. Why is the market going the other way? These thoughts can spiral into frustration or self-doubt, which will cloud your ability to think clearly and make the right decision. Emotional attachment creates a victim mindset. It turns the trade into a personal battle rather than a part of the larger game of probability and risk management. If you allow yourself to become emotionally involved, you'll likely ignore your trading plan and react impulsively, cutting your losses too soon, or worse, holding on to a losing trade in the hope that it will turn around. Turning losses into learning experiences. Emotional detachment allows you to see losses for what they are, learning opportunities. Every time you lose a trade, it's a chance to review your process, refine your strategy, and understand what went wrong. But if you let emotions rule, you'll either wallow in frustration or blame external factors for your losses. This creates a cycle of negativity that affects your future trades. Here's a mindset shift that can help. Instead of asking, why is this happening to me? Ask, what can I learn from this? By changing the way you view losses, you can break free from the emotional attachment to outcomes and instead focus on the bigger picture. If you take every reversal and every loss as an opportunity to improve, you'll begin to detach from the personal stakes and approach trading as a continuous process of growth. The dangers of revenge trading. One of the clearest signs that emotions are taking over is revenge trading. This is when you experience a loss and then attempt to quickly make up for it by jumping into another trade out of frustration or anger. The market didn't treat you kindly, so now you're going to get it back. Sound familiar? Revenge trading is incredibly dangerous. It's driven by emotional impulses, not logic or strategy. In these moments, you might find yourself breaking your own rules, ignoring risk management, or chasing a market that's already moved too far in one direction. You're no longer trading with clarity and patience. You're trading with desperation, and desperation leads to poor decisions. If you ever catch yourself thinking, I need to make back that loss, that's your cue to step back. In those moments, you've lost your emotional detachment. Instead of seeking revenge on the market, take a breather, reflect, reset, then approach the market with the same calm, logical mindset you started with. How to cultivate emotional detachment. Now that we've covered the importance of emotional detachment, let's discuss how you can actually cultivate it. Emotional detachment is not a skill that comes naturally. It's something you need to develop through practice and awareness. Here are a few strategies you can implement. Recognize your emotional triggers. The first step in detaching your emotions from your trades is recognizing when you're being emotionally triggered. For example, are you more likely to panic when a trade moves against you? Do you feel overly excited when you're winning? By becoming aware of these emotional triggers, you can pause before reacting and remind yourself that these emotions don't need to control your next move. Reframe losses as part of the process. Remind yourself that losses are inevitable. Every trader experiences them. It's not the loss that matters, but how you handle it. Instead of seeing a loss as a failure, see it as a data point. What did the market tell you? What can you learn from the move? By reframing losses this way, you remove the personal sting and refocus on the objective analysis of your trades. Avoid over-personalizing your wins and losses. A common pitfall for many traders is identifying with their trades too much. When you win, you feel elated, as though you've proven something. When you lose, you feel defeated, as though you've been personally rejected by the market. The reality is, the market doesn't care about you or your emotions. It's just following its own path. Detaching your personal identity from your trades allows you to make decisions without being swayed by feelings of pride or shame. Implement a post-trade review process. After each trade, take a moment to reflect, regardless of whether you win or lose. Did you stick to your plan? Did you react emotionally at any point? What can you improve next time? The goal is to make your trading more about process and less about results. This helps take the pressure off your individual trades and allows you to detach from the outcome. Use meditation and mindfulness to center yourself. Emotional detachment isn't just about what you do during the trade, it's also about how you regulate yourself outside of trading hours. Practices like meditation, journaling, or simple mindfulness exercises can help you stay grounded, clear-headed, and emotionally balanced. The more you practice emotional regulation outside of the market, the easier it will be to remain detached during trading. The power of a detached mindset. When you can fully detach emotionally from your trades, something amazing happens. You become free. You're no longer subject to the whims of your emotions. You don't feel the need to prove yourself, and you're not swayed by fear or greed. You trade based on logic, analysis, and strategy. No more, no less. This is when trading becomes truly empowering. You start making decisions from a place of clarity, not desperation. You can navigate market reversals with confidence, knowing that whether you win or lose, you're learning and growing. Emotional detachment allows you to stay calm in the face of volatility, making it easier to stick to your trading plan and execute with precision. Conclusion. By now, you've learned that handling market reversals isn't about avoiding them. It's about mastering your reaction to them. The market will continue to surprise you, to test your resolve, and to challenge your confidence. But what you now know is that you don't have to be at the mercy of those moments. You've developed the emotional resilience, mental clarity, and practical strategies needed to handle even the most turbulent times. Through risk management, strategic patience, and emotional detachment, you can turn potential panic into purposeful action. Every reversal, every pullback, and every sharp move against you is an opportunity to refine your process, learn more about yourself as a trader, and grow in your skills. It's not the market's volatility that determines your success. It's how you respond to it. Remember, you are not defined by the outcomes of individual trades. You are defined by the decisions you make when faced with adversity. When the market turns, the difference between those who succeed and those who fail is the ability to remain calm, assess the situation objectively, and act from a place of clarity, not panic. This is your secret weapon. As you move forward in your trading journey, embrace the fact that reversals are inevitable. The key is in how you respond. Whether you're facing a sharp drop or a sudden rally in the opposite direction, your mindset is your most powerful tool. Stay grounded, stay focused, and trust the process. The markets will always move, but it's your ability to remain unshaken that will keep you on the path to consistent success. Trading is a marathon, not a sprint. And as you've learned, the more you master your emotions and approach every market movement with patience and confidence, the more you'll set yourself up for long-term success. Each market reversal, each setback, is a stepping stone toward becoming a trader who handles uncertainty with grace, resilience, and ultimately, success. You're not just learning how to handle market reversals. You're learning how to thrive in the face of uncertainty. Now, go forward with the confidence that you have the skills to navigate any storm that comes your way.